Good evening, everybody. Sorry for the delay. I got another Obnovia hiccup. So I'm not going to take a long time introducing Kirt. He's got some very good trading strategies that he's developed himself. So with that, Kirt, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Hey, fantastic. Hey, thanks for having me on again, Stephen. And hey, sorry, I'm the Mac guy, so, you know, Macs and Obnovia always seem to have issues. So tonight we're going to cover a simple trading system I developed that consistently clobbers the S&P 500, has netted a 91% win rate in over 1,400 trades, 9 major sectors, and the key is it's all about being change your computer and in 15 minutes a month. So on the trading continuum, some of us like to trade more actively, some of us like to trade more passively, some of us do intraday trading, swing trading, all that kind of stuff. What we're going to be talking about today is systems that I've developed for short-term or medium-term swing trading strategy using ETFs. So, of course, the usual legal stuff our attorneys make us say, financial markets are risky, investing is risky. Past performance does not guarantee future performance. So, you know, I like to do up-to-date information. So this is our current open trades using our ETF system, our algorithm that I've coded over the past, 14 years now. And here's the trades through the close of the market today, 2/20/20. So, you know, we're in 9 different sectors, and we're profitable currently on open trades on 8 out of the 9. And that's exactly where we stand. A lot of times our trades look like this. To kind of give you a ballpark idea, these are some trades from last year on the Qs. I'm sure all are familiar with the QQQ, the ETF that tracks the NASDAQ Tech Index. And this was, there on the right-hand side of this trade, you can see that one that was a short, bearish. That one actually ended up slightly negative, and then we've been in a positive. The trade that you see here, we've been up 24% since then. So if you take a look at this slide, in the last year on the Qs, we're up 1%, up 3%, up 16, up 20, then a slightly negative trade like 2 or 3%, and then we're up 20-something. So that's kind of the trades we're looking at. It has been longer trades than we're normally used to. We normally make about 5 switches a month. That's kind of slowed down. This is just, as you guys know, this market's been weird. You know, all these crazy news announcements comes up, and the next day the Dow goes up 500 points. You know, that sort of thing. So we're kind of in that situation. So why ETFs? Well, if you're not familiar with ETFs, you know, this is a massive opportunity to trade just about any sector, idea, country in the world, or sector that you want to get into. You know, there's over 6,400 different ETFs, and that number's probably gone up. But, you know, why should you listen to me? Hey, my investing goals, it's pretty simple. I want to get way above market returns. You know, I don't have to make 100% return a month, 50% return a month. I just want way above market returns. I want it to be mechanical and emotionless. I want it to involve lots of compounding, and that's really key. I want compounding to do all the work. I don't want me to have to do the work. I want the compounding to do the work. I want the trading to be boring, and I want to do it in less than 15 minutes a month. So if that's your investing goal as well, or at least for a fraction or a portion of your funds, obviously some of us like to day trade or do more active trading, and I do as well. But I put the vast bulk of my funds in systematic mechanical trading systems like this ETF tipping point. So a trading system, pretty simple, is everybody concentrates on when to enter and when to exit. And everybody thinks, well, that's it. That's all you need to know. When do you enter and when do you exit? But there's a lot more to it than that. How much money do you put into each trade? You know, if you have a $100,000 account, and assuming that, you know, that's a $100,000 cash account, what happens when a new trade opportunity comes up? How much do you allocate into a percentage of those funds into this new trade opportunity? How much money should you risk on a trade? All these things are things that you need to consider. And in my opinion, we should only trade objective, quantifiable, emotionless systems. To me, trading is stressful enough. I don't know about you guys. I don't know if you've ever been stressed out trading. Maybe it's just me. But when I trade objective, quantifiable, emotionless system, it takes some of the heat off of me. It takes some of the heat off me mentally and assigns it to the system. So my job goes from I'm going to make 20% return on this trade. My job goes to I'm going to execute my system flawlessly and the results fall where they may, right? So proof, evidence, facts, what I'm talking about today. Here's some log charts of the 9 sectors that we trade. This is the DIA, going back to 2006. We've actually created a little mini hedge fund or a model portfolio, and we'll show you the results of that here in a second using actual brokerage statements and all that kind of stuff. But of course, like we've mentioned on the compounding, if you get a system that has a positive expectation, you can start compounding. That's where the miracles happen. The miracle is not a trading system. The miracle is a trading system that allows you to compound. And so, but even non-compounded, we're talking we turned $10,000 into nearly $60,000 on the DIA, and millions with compounding. Here's some of the types of trades that you would get into on the DIA in the last couple of years. S&P 500 looks a lot the same. S&P 500 obviously is like the Dow, shot to record highs, and with compounding, the switching back and forth between bearish and bullish has allowed us to make some pretty spectacular compounded returns. NASDAQ has one of been our top performers in live money trading since marked by this gray area since we launched our mini hedge fund. We're up nearly 100% on the NASDAQ, trading in ETF, folks, in the last little bit over a year. There's NASDAQ trades. Banking, a lot the same, which is the KB. Oil, we've actually had some losing trades on oil, which is good because, you get spoiled if you get too many winning trades in a row. But we've had a few losing trades on oil. With oil, with the compounding, I don't even want to say the numbers because it's just ludicrous. But the percentage returns are crazy. And oil, the nice thing is, it's a commodity. It's cyclical. It goes up, it goes down. Unlike, stocks, which for those of us with a short memory only seem to go up right now. Gold, we've got a great trade on gold on right now. Semiconductors, which is another, critical component of the tech sector. And real estate, I really like the real estate because, that's kind of a little bit not anti-cyclical, but not exactly 100% correlated with the stock market. And materials, which is, building supplies. If you're going to build stuff, you got to have materials. So oil is our most profitable sector. We've accumulated over 970 net percentage points before compounding. Our best trade on oil, we're up 216%, 131 days. Worst trade, down 16% in 50 days. So overall, this model portfolio that with real money, it's currently $117,373 with compounding. So right at our expected 2 to 4% a month right now with real money. So here's the real money. These are all dollars with a name on every one of them because I put this money in, $90,000 and turned into 117 so far in live real money trading. So what does it mean for me? What do I consider when designing a trading system? Where do these trades come from? And so here's where we're going to get a little bit controversial. Don't worry, Stephen and I go way back. We've been, in the same industry. And I don't think actually we've ever met in person, but we've met virtually many times. But my definition of technical analysis is kind of 50 years of trader arguing about stuff that works sometimes. So, if you go to Amazon and type in technical analysis, you'll have no shortage of options. Again, there's 50,000 books on the subject of technical analysis alone. So my controversial statement for the day, moving averages suck. We can debate this till the cows come home, and I'm perfectly fine with that. I love debating and talking about all this kind of stuff. But let me explain why I say that. Why do moving averages suck, in my opinion? Technical analysis by itself doesn't do it. Let's face it. We really only have 3 basic elements to work with, and everyone is looking at the same data. We have price, time, and volume. Right? Price, time, and volume. That's it. Now, if you look at most technical trading indicators, they all use price in some format, and most of them use time. Candlesticks, like you guys are familiar with, use time. Obviously, whatever time series you're looking at. Moving averages use time, but volume. There are some indicators that use volume. We're going to talk about some of them tonight. But in my opinion, volume is the hidden stepchild of this whole technical analysis game. If you go to Investopedia and just type in technical indicators, There's no shortage of those. We got absolute breadth index, amplitude, a Rune oscillator, Andrews pitchfork. I've even heard of some of these, right? And this is just in the A's. It goes on and on and on. But everyone scrambles to put their name on a proprietary indicator that attempts to manipulate these three core elements in just a slightly unique way. The result produces a result different than the next guy. But the basic failure of all of these, in my opinion, is they all use moving averages. Some of them use standard deviations. You got Bollinger Bands, you got MACD, you got stochastics. But even when you're new to trading, you know that moving averages can be a huge gotcha. If they're too short, you get whipsawed. Too long, you get left in the dust. So for the last 15 years, I've actually been trading over 25 years now. I was like 22 when I started trading. That's back when I was trading futures, and you had to call to place your order. You had to pick up a program in your broker's number, place a call, talk to the guy, say your account number, this is account so and so, about to buy this at market or whatever. So I've been trading for a while. But the last 15 years, I've avoided moving averages like the plague for just that reason. Sure, I still look at stochastics, my own secret sauce, a 533, but only when I'm watching for a trend change and want confirmation. I don't even use candlesticks anymore, even though I studied them for over a year. I try to look for those areas that are not being monitored by other folks, because that is what, for me, makes all the difference. I don't want to run with the pack. The pack is invariably wrong. So what's this book? 1963, a guy named Joe Granville, who you may have heard of. If you haven't read anything about Joe Granville, you should, because he's a fascinating cat, that Joe Granville. But he came out with this book in 1963 called The New Key to Stock Market Profits. I came across this book nearly 15 years ago, and it's changed my life. It has literally made me millions of dollars. Between the algorithm that I coded to trade this with ETF tipping point and trading my own funds, I'm talking over $10 million. So I have a soft spot in my heart for this book, because while the book itself isn't even very good, it's kind of a tough read. But what it did is it revealed to me this three-word phrase: volume precedes price. Volume precedes price. So if you take nothing away from this, just remember that. Volume precedes price. What Joe Granville talked about in his book is he invented an indicator called OBV. OBV it's just a simple indicator. It's really there's not much to it. It adds a period's volume when it closes up, subtracts a period's volume when it closes down. The cumulative total of those volume additions and subtractions forms the OBV line. This line then can be compared with the price chart for divergences or confirmation. So OBV came out in 1963. Now, can you think of any improvements in computing power that have happened since 1963? I showed 2018 on here, and it's even later than that. 1963 to 2020, any computing improvements been made at all? Now, when Joe Granville talks about his book, he's talking about calculating all this stuff by hand, right? So if we look at the accelerating pace of change, this is just a chart that shows computing power since 1963. And if you look on there, 1963, we were still in transistors. We didn't even have any integrated circuits. No computers as we knew it, as we now know it, even existed back then. The first integrated circuits and personal computers were when I was a kid in the mid-'80s. And now, obviously, things have made leaps and leaps and bounds every single year. So here's what we do. So this is kind of a little quick quiz for you. If there was an idea that came out in 1963, and this Joe Granville guy, he calculated it had validity. It worked. Obviously, they didn't have facilities for back testing and forward testing and data segregation, all that kind of stuff we use now. But when they calculated it and they used it in the market, it worked. Now, why did it work? Well, when he came out with the book, nobody else knew about this. Nobody else was doing this calculation. It wasn't freely available on every charting package under the sun, right? Which it is, OBV is now. So here's what we do. So we took that concept of the OBV. We look at every single stock transaction individually that makes up the basket of that ETF. That means, for example, for the S&P 500, I keep a running total throughout the day. Well, when I say I mean my server, not me by hand or anything. My server keeps a running total throughout the day as well. There's more buying than selling going on every single trade, tick by tick. So the question is, how are you going to know whether there's more buying pressure or selling pressure on every single trade, tick by tick? What would reveal that to you? What is also present at this junction when a trade is executed, what other prices are also present? Well, it's pretty simple. This S&P 500 companies, these are not inconsequential companies. Just looking at the A's, we're talking 3M and Abbott Laboratories and Activision. And, so we're talking millions and millions of shares of these that are traded per day. And we have a server that's processing this data and checks for one thing and one thing only. And that is pretty simply, we're checking to see if there's more buying pressure than selling pressure on a single transaction. Well, how do we do that? Well, also at the time present when a trade is transacted, there's the bid and there's the ask. So the bid is a price a buyer is willing to pay for a stock. Ask is the price a seller is willing to sell their shares. And the difference between those is the bid-ask spread. Right? Pretty simple. Now, we evaluate the bid price and ask price of the trade, and if the sale went off closer to the ask price, then the seller was willing to hold out for a higher price, and the buyers were willing to pay extra to ensure they got those shares. Conversely, if the sale went up to the bid price, then the sellers were willing to move their prices down towards the buyers who were in control, able to force the hand of the sellers to reduce the price. So that then establishes a positive or negative tick volume, which, like Granville's originally OBV indicator, allows us to set with greater confidence and more precise measure of where the real power is. So this is akin to a massive river. If you go look at the Mississippi and you look at the surface of the Mississippi River, at times it looks like it's not even moving. It's maybe moving at 1-2 miles an hour in some of its flat spots. But what is the volume of water that's flowing through that sucker at any point in time? Now, if you contrast that, if you go look at a stream or a creek that's running like crazy in the spring from snow melt off, it appears that it's got all kinds of things going on. It's wild and frothy, but the volume of the water just doesn't even compare. It doesn't matter how fast or slow the Mississippi is going. The volume of water pushes and pushes and pushes. So at the end of the day, we can look at a losing day, but we would know that with the on balance, it was actually a bullish or bearish move for the majority of the stock. At that point, we simply do a cumulative summation for the next 13 sessions. And with that, we have a pretty good idea of what percentage of stocks are advancing on hidden power or failing despite rising prices. So at the end of that day, out of 500 stocks in the S&P 500, we know how many are on positive footing, greater than 50% with more real accumulation, how many are on negative footing. So this is what we call our ETF tipping point. So it works just like a tipping point in real life. If you ever read Malcolm Gladwell's book, once it flips over, it tends to stay that way. It doesn't whipsaw a lot. Once it flips, it tends to flip over, and generally, there's a high correlation with the market changing in that direction. So I'm happy to reap the rewards of the product, whatever it's called. Notice that this is all done without the use of moving averages or any commonly available technical indicator. Seeing as how this has been collecting this information over the prior 13 trading days, we know where each company within the ETF sits in terms of the positive and negative stance. When it switches from positive to negative, then we have a sell signal and vice versa. Okay? So let's walk through the whole process, 3 simple steps. I'm giving you the actual formula that we use. This is something I've developed. Obviously, here on the screen it shows $175,000 in programming costs over the years. It's actually, the last time I checked, I'm at $247,000 in costs on this over the years. But obviously, it's been well worth it. At this point, I've decided to forego the development of your own tick-by-tick collection platform. If you haven't had a chance to look into more of the volume states, highly, highly recommend it. What I recommend doing is finding something that worked in the past that has fallen into disfavor that hasn't been modernized for the 2020s. That's what I do. I look for these ideas, things, indicators or ideas, strategies that worked in the past when, before there was internet signals, internet connections, and then we adjust, modify, and attempt to see if we can get them to work now in the future. So what we do is we publish a signals notification after 12:30 p.m. Pacific, 3:30 p.m. Eastern on Fridays. You can trade the next day the market opens if you can't see or make those trades during the day. We buy or short the 1X ETF or the single ETF, or we buy the 2X ETF or the 2X Inverse ETF, or buy calls or puts on the 1X ETF or buy calls or puts on the 2X ETF. Of course, when we're talking about options and ETFs, that's apples and oranges, right? We're not going to ever tell you to put all your money into a single an options contract as opposed to an ETF. You buy a DIA or SPY or something like that, you're buying a massive ETF that has bid-ask spreads of a penny. When you buy the options, obviously you're getting more into the speculative side of things. We recommend, typically we're buying options with a delta of about 70, about 4 to 6 months from expiration. What that means is if we get into an option with a delta of about 70 and the market goes in our favor, multiple strikes, 5, 6, 7 strikes, all of a sudden our little tiny investment to control 100 shares of stock that cost around $1,000, all of a sudden, we're controlling getting the same return as if we had spent 3 times that amount of money on the ETF. So just in general. So our current open trades, you can see exactly where we're at. We're not doing anything flashy. We're not day trading. We don't have dozens or hundreds of trades per month. Actually, right now is a little bit on the boring side. I mean, boring in a good way. All the trades are up. All the trades are positive except for one, right? 8 out of 9, which is pretty typical. But we have been in these trades for a lot longer than normal. Usually, our average trade length is about 40 days. Some of these, if you follow the market, you kind of know what I'm talking about. Since the summer. It doesn't seem to matter what's happened. The market seems to drift higher. It hasn't rocketed higher. It's just kind of drifted higher. So that's what we talk about. Is we teach you to hold those positions, either trade the single ETFs, the double ETFs, and some of our members go into the options as well. I myself am an options guy, so I do a lot of stuff with the options. But we're very careful to make sure that people aren't going whole hog on options and taking more risk than they need to. So we hold those positions till they receive a signal to reverse, or rarely go to cash, re-enter the trade Friday of the next week. An ETF is either bullish or bearish in the system. We try to be in the market at all times. If you're only comfortable playing to the upside, only trade when bullish, and go to cash for that ETF when they are bearish. I actually have a long-time customer from Uruguay that just contacted me and told me that was his strategy. He just plays the bullish trades when we're bullish and goes to cash when we're bearish. He just wants to be a little bit on the conservative side. So basically that's what we do. Do it again a couple hundred more times. We've done it over 1,487 times the past 14 years, averaging about 5.2 trades a month. So my hidden secret, find a system that has a positive expectation, read it makes money in the long run, right? On average, every trade you place makes money on average, and compound the heck out of it. Compounding is where trading actually gets interesting. Compounding, without compounding, trading for me is a little bit monotonous, a little bit, dare I say it, boring. I'm not trying to be a Vegas gambler or betting on the March Madness or anything like that. That's not why I trade. I'm not in it for the action, so to speak. I like my systems to be boring, and I like the profits to come from compounding. So there's our current open trades. Like we talked about my life goal. Pretty simple. I want to start with the end in mind. It's never let my money pursuits take precedence over my real life. So just to kind of give you a little flavor of what I'm interested in, the things that I'm about, I'm going to tell you a little bit about kind of my background, things I've been through. So I'm from a small dairy farming town, Preston, Idaho. If you ever saw the 2004 movie Napoleon Dynamite, that's my hometown. I grew up on a ranch. We had alfalfa and wheat and range cows. So I never wanted to be chained to a desk. I'm used to being outside, doing stuff, right? But of course, I have my wife and 3 kids. So I like adventure. I like the outdoors. I live in the Pacific Northwest, on the border of Idaho and Washington. So this is one of the beautiful lakes that you can only get to by backpack in North Idaho. This is our lake place in Spirit Lake, Idaho, and another shot of that in the summer. This is where I want to be. I don't want to be stuck behind a computer worrying about a few pennies here and there. Or, I like to travel. This is Guatemala. This is a volcano erupting in Guatemala a couple years ago. We were there in Antigua, and it's pretty nuts that you can sit in the middle of a civilized town and watch a prehistoric volcano erupt. Tikal in Guatemala, Semoc Champey, hiking the Inca Trail in Peru, Mexico, surfing in Costa Rica. I've done a lot of stuff. And I'm sure you're just like me. You want to do more of those same sort of things. You want to have more adventure, more family time in your life. And so that's what I'm all about. This was just last year. I spoke at the Financial Marketing Summit in London. And of course, if I'm going to do some work, I pulled my wife along and made her go to, this was in Budapest, Hungary. and take a trip through Eastern Europe for a couple weeks. That's my wife there in Vienna before getting on the boat. So I've been to about 60 countries in the world, and those are all the countries in red. The countries that I want to go to are the rest of them, the ones in gray. So that's what I'm all about. We have some time for some questions. I do have some kind of FAQ stuff at the end. If you guys want to ask questions, it's perfectly fine. I know we have a special offer link that the team's going to put on. Just very briefly, in about 30 seconds or less, I'll give you guys a special offer if anybody's interested in joining with us on ETF Tipping Point. It's pretty simple. We have an offer. It's either $997 for 6 months access or $2,997 for 3 years access, which is a 50% discount. I hate overhead. Could get fancy marketing guys, hire some full-time sales guys, but that's not me. This is my office here in Spokane, Washington. If you're ever in the area in the Pacific Northwest, that's us right there, 2426 South Dishman Micah Road, suite number 5, in this kind of crazy office complex that's got some really cool stuff. Basketball court, and I got my own gym downstairs and things like that. But, we've been at this a long time. I've been in business 15 years, A+ rating from the Better Business Bureau, 0 complaints, right? I mean, doesn't really get much better than that. And, of course, like we talked about, we've set up our own mini hedge fund. This is when we launched that at the end of 2018, set aside $90,000 to put into that, track the results in real time along with our members. So if this sounds like something you might be interested in, we do have a 2-part performance guarantee. Part 1, go through the entire training, start trading live or in demo mode. If you don't love it, get a complete refund anytime within 90 days of ordering. Simply submit your trading log. We'll issue a prompt refund. Part 2 is to go along with us, learn the system, use it for a full 6 months, executing all the trades that come up. If you don't at least make back your system investment in profit, I'll personally work with you for free until you do. So we do have a special link for you guys. So we have the normal ordering information, but we'll put a special link up here for everybody. ETFtippingpoint.com/6-month or ETFtippingpoint.com/3-year, or you can call it our secure voicemail line, 509-720-7867. We have some questions on this. What has been your worst drawdown? The worst drawdown, I'd have to pull it up, but on one of the sections, worst drawdown, I believe, was on oil because we had 2 losing trades back to back, so around 15% on oil. Do you have to use our platform? No, absolutely not. You can use any platform under the sun. Our stuff is all delivered through a very simple Google Drive, right? All of our servers are, basically, not web facing, or, it's not publishing continually on the web. We've been doing this 15 years, so we're been at this a while. So we publish those every Friday is when the trade notifications get notified. They come out in email as well. And this isn't if you don't jump on it right then, you're going to miss the trade. If you can't make the trade Friday before close on Friday, just put it in over the weekend for open on Monday. Jack asked, how often do the trades occur? How long do they generally last? Well, let me get to that. Let me flip over to there. So right now, somewhat of an anomaly. Even as system guys, we don't predict the future. We're just going off something that has an edge, right? So these trades are really, really long for what we normally do. Generally, the trades are about 40 days in length. Now, of course, when you have trades that are less in length, 40 days in length as opposed to over 100, some of these are right now, gives you more opportunity for compounding, of course. That's really what we're after. But the market has continued to be bullish. The indicators, our ETF tipping point stayed bullish on all of these sectors except for oil, which 14 days ago switched bearish. So in general, trades are 40 days. Currently, right now, we have some that are over 100. We put on 9 sectors. These are the exact 9 sectors we trade. We trade the Dow, we trade the SPY, the Qs, KBE, which is the Finance and Banking Index, OIH, which is oil, GLD, which is gold, semiconductors, which is SMH, IYR, and XLB. The reason we call this little mini hedge fund is because you notice 2 out of the 9 are commodities. Oil and gold are commodities, essentially. It's debatable whether gold's a commodity, but it trades like a commodity. And then you have the large caps. You have the SPY and the Qs and somewhat the DIA. And then you got the kind of the random sectors. You got the banking index. You got the semiconductors. You got real estate, and you got materials. We've done it this way on purpose, obviously to flesh out our returns, to increase our alpha while decreasing our beta by offering us more exposure to oil and gold, which are help with reducing risk overall. So we always have 9 positions on. And let's see. Any other questions we got come up? I'm not sure how much more time we've got left because when we started, I think we started about 5:15, so I've probably got just a few time for a few questions left. I'll go through a couple of the frequently asked questions type of stuff. If you guys have more, go ahead and ask them. That's a great question from Niaz. Why not extend your method to stocks? Why limit to ETFs? The reason for that is because this works best in highly liquid, high volume issues. So with stocks, obviously there are some high volume stocks, and we do perform it on an ad hoc basis on some high volume stocks. But in general, what we were looking for with this is a baseline. We wanted 9 sector ETFs at least that all had pretty decent double ETFs, and then had, to ask even more of it, is we want a decent amount of options, open options interest on the single ETF options, and open options interest on the double ETF options. That's why we've stuck with this core 9. We will be expanding in the future as more of those ETFs come online, but for now, that's what we have. Let's see, here's the question. Do you have an example notification? So an example notification would be pretty simple. Like if you take a look at this last trade on OIH, we were bullish on OIH. And so on 2-3, which would have been a couple of weeks ago, we switched to bearish. And so the notification just said, please switch your bullish position on the OIH from bullish to bearish. If you're using the 2X ETFs, that means sell the DIG ETF that you have, which is the 2X bullish, buy the DUG, the 2X bearish. That's it. Other questions that people sometimes have is, well, what happens if the trades go long and the options get close to expiration? If we're holding in the money options that get close to expiration, we just need to roll those options contracts. It gets a little messy because the numbers don't exactly match up, the prices and all that kind of stuff. But we typically roll the options whenever we get within 30 days of expiration of the option. We'll generate a new option. It'll be placed on the chart. If you held the old ones, you get rid of them. Presumably at a profit, obviously, if we've been in these trades for a long period of time, and then get into the new ones. Great question from Jake. He says, are your percentage changes shown above for a straight purchase or on the options? Every calculation that we do is on the single ETF. So if we're up 24% on this Qs trade, you're going to be roughly up double that on the double ETF trade, and factors above that up on the Qs call trade, and above that on the QLD call trade. We don't even really like to talk about the options returns just because it gets kind of crazy. But the flip side is the same as well. If we're down 3% on the OIH on the single ETF, we're going to be down nearly 6 on the double ETF, and factors above that on the individual options as well. But we track everything according to the ETF, the single ETF, just to keep things simple. We understand a lot of people are going to trade the double ETFs, but that introduces another variable, another layer of complexity. And frankly, we don't control the price movement of the double ETF, and we're making the predictions on the single ETF. So we offer you the double ETFs as an alternative, as a way to trade them. But some double ETFs are awesome, and like if we look at the DIA, the DDM, it's going to be almost exactly 18-20%. Now, because this trade has gone longer than normal, you're going to have some degradation of performance over time with the double ETFs. But when you're talking the normal trade length, that's not an issue at all. This is from Jake. He says, is this system a black box or something to share with clients? We share the exact formula that we shared on the webinar is the formula that's applied on all 9 sectors, unchanged, unvarnished to these 9 sectors. We don't give you a scanner or something like that to apply on ETFs. We give you exactly this right here. Now we have people who use the services for other things. For example, if you want to do directional options trades, or do like I do, I sell. A lot of times when we're bullish on OIH, I'll sell calls. Sell puts. That sort of thing for a weekly or monthly income. You can create, obviously all kinds of directional strategies using options, using this as the base underlying system. Any other questions we got? All right. Well, I think we're about out of time. In the interest of time, we do have a couple other FAQ questions that I can go just for a minute or two, just to balance everything out. People ask, well, what about these events like Brexit or flash crash of 2010 or recession of 2008? What kind of experience do you need? You can trade an IRA or 401k. How much starter capital? I'll answer a couple of those. Why aren't you retired on a tropical island somewhere? That's my favorite one. Why are you selling the system to us? How many versions of the system gone through? Pretty simple. So for most of the major, non-stochastic events that happen in the markets that are unpredictable, black swan type of events, we were actually already on the right side of the trade. 2008, we went up 56% on a SPY trade, right when everybody else, was losing. Flash crash, which did turn out to be hardly anything. I can't believe that's been 10 years now, but we were already short. Brexit, same thing. We're short on the SPY during that. There's not really an experience needed. Desire to learn, basic trading account, software, commitment to make the trades. That's really more than anything. You can trade in IRA or 401k. It gets a little bit more complicated because you can't use margin. It's not a margin account, so you can't sell short. So you mostly be limited to using the double ETFs, which really isn't really a problem. Starter capital, we recommend at least $500 per sector or $4,500 to trade all 9 sectors. With less capital than that, just trade fewer sectors to build up the account. Why aren't you retired on a tropical island somewhere? This one just always amazes me. We're talking about trading, folks. Even if I had 1,000 students, all with $100,000 invested in the SPY, for example, that would be 469,000 shares. This is examples from a while ago, $213 a share, which would be 1/2 of 1% of the total shares traded. And we're nowhere even close to that in terms of students. So there's no faster way for me to grow my own trading account and make frequent deposits to further the compounding. So, for example, if we sold 25 students today at $1,000, that's $24,000 I can put in my trading account. Why wouldn't I? It doesn't affect anybody's results. We're talking with these massive ETFs with millions and millions of shares. I think that about covers it. Of course, we did talk about we do offer money back guarantee. We want people to be happy. I'm in the business in the long run, right? I've been doing this for a long time. So we tell people, hey, go through the entire training, start trading live, demo mode. Don't love it, get a complete refund anytime within 90 days of ordering. Simply submit your trading log, we'll issue a prompt refund. We want you to take the trades as they come up. It's pretty simple. You don't even have to risk money. Just take the trades in demo mode as they come up. I think that about covers it. So if you want to claim one of the spots, of course, go to etftippingpoint.com/6-month or etftippingpoint.com/year, 3-year, and we can take care of that. All right, we'll turn it back over to Stephen. I think we're about out of time. We're at 5:56. I think that's about all we have time for today.
All right, well, very good information, Kirt. Everybody, take a look at it. Again, Kirt has worked on this system for years, and so you got to assume that with the just the investigation into a successful trading program, there's lots of good logic behind it. So take a look at it. This might fit your trading strategy. So, Kirt, very good information. I appreciate you showing it tonight.
Hey, thanks, Stephen. Thanks for having me on.
All right, great. Everybody have a good evening. We will see you bright and early in the chat rooms. We'll see you then.